Bonds are the quiet backbone of the financial markets. Stocks might get the headlines, but bonds? Bonds are what hold the system steady. They're how governments fund spending, how cities build schools and roads, how corporations expand, and how investors, large and small, build income and stability into their portfolios. In this episode, we're talking about debt securities, the math that governs them, the yields that measure them, and the risks that define them. A bond is a loan. The investor is the lender, the issuer is the borrower, and the promise is simple: periodic interest payments and the return of principal at maturity. Let's start with the language. Every bond has three core features: par value, usually $1,000, a coupon rate, the fixed annual interest payment stated as a percentage of par, and a maturity date, when that par value must be repaid. If a bond has a 6% coupon, it pays $60 in interest each year, typically in two semi-annual payments of $30 each. Now, when a bond trades in the market, its price fluctuates, but the coupon payment never changes. So the relationship between price and yield moves in opposite directions. When interest rates rise, existing bond prices fall. When rates fall, existing bond prices rise. It's one of the most fundamental inverse relationships in finance. Let's define the different kinds of yields, because the Series 7 will test this. Nominal yield is simply the coupon rate, the number printed on the certificate. Current yield measures the return relative to the bond's market price. It's calculated as annual interest divided by market price. For example, a 6% bond trading at $900 has a current yield of 60 divided by 900 equals 6.67%. It's higher than the nominal rate because the bond is selling at a discount. Yield to maturity, or YTM, takes it further. It reflects the total return an investor will earn if the bond is held to maturity, including the interest payments, plus any gain or loss on the difference between the purchase price and par. If a bond is purchased at a discount, the yield to maturity will be higher than the current yield. If it's purchased at a premium, the yield to maturity will be lower. And finally, yield to call, or YTC, applies when a bond can be called early by the issuer. For callable bonds, the yield to call is based on the call date and call price, not the final maturity. Here's a simple order of yield relationships to remember. For bonds trading at a discount, nominal is less than current, which is less than yield to maturity, which is less than yield to call. For bonds trading at a premium, nominal is greater than current, which is greater than yield to maturity, which is greater than yield to call. That pattern, nominal, current, yield to maturity, yield to call, tells you how the bond's price relates to market rates. When you see a question that asks which yield is highest or lowest for a bond purchased at a discount or premium, that's the rule to lean on. Now, not all bonds are created equal. A corporate bond is backed by the issuer's full faith and credit, or, in some cases, by specific assets. A treasury bond is backed by the U.S. government itself, considered risk-free in terms of credit. And municipal bonds are issued by states and local governments, often carrying the benefit of tax-free interest at the federal level. Among corporates, there's another distinction: secured versus unsecured. Secured bonds are backed by collateral. Mortgage bonds are backed by real property. Equipment trust certificates are backed by machinery or vehicles. Collateral trust bonds are backed by securities held in trust by a trustee. Unsecured bonds, often called debentures, are backed only by the issuer's general credit. And subordinated debentures stand last in line if the issuer defaults. Credit quality matters. Ratings agencies like Moody's and Standard & Poor's evaluate issuers based on their ability to meet interest and principal payments. Investment-grade bonds are those rated BBB or higher by S&P or BA or higher by Moody's. Below that, you're in high yield or junk territory, where the yields are higher because the risk is higher. And the exam loves to test this too. Here's a quick memory cue. S&P uses plus and minus signs. Moody's uses numerical modifiers like A1, A2, and A3. Let's talk about pricing terminology, especially for municipal and treasury securities. Quotes are often expressed in percent of par. A bond quoted at 98 is priced at $980 per $1,000 of par value. Treasury notes and bonds, however, are quoted in 30 seconds. So a quote of 98.12 means 98 and 12 30-seconds percent of par. That's $981.25. And Treasury bills, short-term instruments with maturities of a year or less, are quoted on a discount yield basis. Those yields look a little backward because they're based on the discount from par, not on the price itself. So when you see a T-bill quoted bid 4.26, asked 4.22, that's a discount yield quote, where the lower number actually means a higher price. Now, bonds carry risk, different kinds of risk, depending on what you own. Interest rate risk is the risk that prices will fall when rates rise. Reinvestment risk is the risk that future coupon payments will have to be reinvested at lower rates. Credit risk is the chance that the issuer defaults. Inflation risk, sometimes called purchasing power risk, is the danger that fixed payments lose real value as prices rise. Liquidity risk affects thinly traded or unrated issues. And call risk applies to callable bonds, which may be redeemed early if rates fall, leaving investors to reinvest at lower yields. Each of those risks tells you something about who the bond is best suited for. Conservative investors usually want lower yield, lower risk, and strong credit. Aggressive investors may take on higher yields for the potential of greater return. For exam questions, remember the hierarchy. U.S. Treasuries have no credit risk, only interest rate and inflation risk. Corporate bonds have all three: credit, interest rate, and inflation. Municipal bonds carry minimal credit risk but can be sensitive to tax law changes. Bonds are where math meets trust. Trust that interest will be paid, trust that principal will return, trust that the promise holds. And the Series 7 asks you to understand not just the math, but the relationships between yield and price, credit and risk, interest and time. Because once you can read a bond quote and know what it's really telling you, you can read almost any market. Next time, we'll explore municipal securities, how states, cities, and local agencies raise capital, and how the tax advantages make munis a world of their own.